Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I will be your host for about the next, I think we're going to be short and sweet this week, the next 20 minutes or so. I've been traveling all week, had a great trip to Chicago, met a lot of friends, including one of my mentors in options, and spent some time with Jim Bittman, author of 3 or 4 option books. And just had a nice trip. Had a nice trip, a little bit of business, a little bit of pleasure. Enjoyed. Went up and the Cubs weren't in town when I got in, so I went up and watched the Brewers game. Made the trip up to Milwaukee, my old stomping grounds up in Wisconsin. Didn't hang out a lot in Milwaukee, but I always did enjoy going to Brewers games. And now we came on Wednesday and. Interesting enough, you almost would think I had inside information on this, but on Wednesday decided to do an oil trade, which is a little bit out of the norm in Options Guide TV. You know, we always like to look at an SPX trade during earnings season. We look at a lot of earnings, and a lot of the trades that we're doing, we're just trying to learn. We're not. I guess it's not a systematic approach because we're doing three a week. So we're coming up with trades on stocks that are going to move, and we're trying to learn the dynamics of how the strategy works. Now, last week we did Chewy, around Chewy's earnings, and the expected move really, worked out. So what the options market was saying was the expected move was about 10%, and Chewy actually went down about 10%. Chewy right now is trading at 41.63. On the show, we did a 3-point wide butterfly. We doubled on the trade, put it on for 75 cents. At worst case scenario, you would have gotten $1.50 for the trade. If you hung around, you're actually doing pretty good because the stock's at 41.64. So if you did not close it, which then shame on you because you should have, now you're going to be paid for your mistake of not closing it after the initial move to the downside, because Chewy's going to close right around 41.66. And I get a little bit confused because I had a little bit different trade. I put it on the next day. I did it 4 points wide, and this was 3 points wide. I think we were right at 41. So yeah, you'd be doing well on that trade today if you hung around. I didn't even put 2 and 2 together until I started to think about it right now. I put the trade on for $1, so I paid 25 cents more, and then I closed it for 3. I had a limit order in, and it got hit yesterday, and I was able. The butterfly long put spread was 4 points wide, and I was able to close it for 3. So I almost got the max. Well, in my mind, on a butterfly, that 1 point away is a ways away from the max, but it's very hard to get the maximum on a butterfly. So to me, I consider that getting the maximum. So then we did USO, and in the interim from Wednesday until Friday, there's some geopolitical things that happened. So oil has spiked today. And because of that, my biggest thing that I think is interesting to see is that we chose the USO, and I picked the USO mainly because of what was going on with the oil chart, with the way crude oil had made a little bit of a breakout, potential to move up. So one of the liquid underlyings that like to trade if you want to trade oil is the USO. And this morning, the oil was up 7.5%, and so was the USO. So to get the follow through on the USO is good. There's not a ton of ETFs that are out there, especially in the oil world, that track the price of oil perfectly. Like, well, for example, gold, the GLD is a very good ETF that tracks the price of gold, and gold is up a little bit today. Obviously, there's just safe haven trades are doing fairly well. The dollar is up today too, and the USO is up. So we wanted to sell a put to buy a call. So let's finish our trade. We went out, and I have this trade set up here. So let's take a peek at it. And here's USO. Now it's dropped a couple of percent. It's up $4. It's at 79 cents, which hurts us a little bit because we sold this trade, and I think we brought in $1.60 on the trade. I took my screenshot, and the word screenshot actually was actually covered the limit price that we paid. But based off of the quotes that I saw when I took it, that was saying that we did it for a net credit of about 150. I think we're looking at 160. And we were going to take that 160 to buy the call. If we would have bought the call, well, then we would have really been speculating on if we actually knew something about the geopolitical world. But we sold that call for 160, and the plan would be we sold that put spread for 160. We are, because of implied volatility, we are up about 70 cents. All right. So right now the market is at 84 cents net credit to the account. Yeah, we're up about 50% on it. Now, you could just close the trade and move on, but I do think that this kind of confirms the breakout. A lot of people will say that, the initial jump up in oil prices may wane because, it's a panic scenario. But I kind of like finishing the trade. We said that we were going to sell a put spread, and if we got some movement to the upside and the breakout kind of confirmed itself, that we were going to buy it, use the credit from the short put spread to buy an out of the money call option. We were looking at the July 11th expiration. It's still 28 days away. The stock right now, so here's the trade, and I'll scroll down just to show you the strikes. When we put this on, the stock was right around, or the ETF, I should say, was right around $73. We sold the 72, bought the 65, brought in $1.60. We are up about half of that, 84 cents in a couple of days. It's a very solid trade, but now we're going to go and take that $1.60 and we're going to double down, and we're going to buy a call option. So in this instance, wow, the price is really wide on this July 11th. That's ridiculously wide for the USO. 260 by 180 for that 85 strike. Well, I definitely want to work this. And if you're going to just buy a call option, you're going to work it, and don't let the market move against you. That's just, USO is usually a very, very good underlying as far as the markets are concerned. I don't like that at all. So one standard deviation delta is 22 on this one, 186 by 187. All right, there's the 90. Let's close this out. Let's just look at buying the 90. See where the midpoint is at. 146. All right. So we'd have about 15 cent net credit. Keep it at 145. Now, if we did send this to the trading floor, right? If we sent this to the trading floor, what you would see is we're willing to accept $1.45. So what will happen is this bid will move up to $1.45. The ask won't move down because that would mean that we're filled, right? Because we're trying to buy it. But the bid will move up, and you'd see a market that would say 178 by 145. Now, I would leave this one in there for a little bit and see if we get filled. Now, the open interest on this is only 6 on this particular contract. We got a lot of open interest here at the 80 strike. I don't have the volume in here, but yeah, I'm really surprised to see how wide this is. But it's an event, and when events happen and people rush to trade things like this, like oil, yeah, sometimes the bid-ask spreads will widen. So 145, and I want to make note of where the underlying is at, 79.25. And if this is moving a lot, especially against me, I want to make sure that I get a decent fill on this. So I prefer to trade with another retail customer, somebody coming down and selling that option contract, and then I get to buy it from them at 145. But your quote will get represented if you put it in on a wide bid-ask spread. So this would be one that I would watch. And one of the things about it is it's not a spread. It's a single leg option contract, and that makes it harder to get your fills at the prices that you want. When you come in with multi-leg, when you come in with at least 2 legs or more, a standard 2-legged spread or a butterfly, every leg that you add, you have a better chance of filling at the midpoint. It gets presented as a package to the trading floor, and they can choose to take the trade at the midpoint or not. So in this instance, I'm looking at this more like a fill or kill. Haven't said those terms in a long time. That I'm gonna put it down there at 145 and see if we can get filled at that price. And if not, in a couple of minutes, I'm going to cancel it and then maybe think about readjusting it and looking at that trade and see where we end up at. But there's a lot of people looking at USO today. I'm assuming because of what happened. And yeah, and I would sit here and try to work this. That's interesting. Did somebody just put in our order? Because our market just moved to 145. So somebody I think somebody watching the show just put in an order. Oh, there we go, 146. That was just too coincidental that the market went to 145. Well, we had a 145 limit in. Market's now 170, so it's moving. It's moving. Delta stock is at 779. All right, so that's our trade, and that's all that we're going to do today on Options Guy TV. We sold the put spread on Wednesday. We said that if we got the confirmed move to the upside, we would take the credit from the put spread and go out and buy an out of the money call option. Now we're up 80 cents on our short put spread. We made half of the premium received in 2 days. So obviously, you could just take that out and say, well, we got lucky on that one, which that's literally, there's no way that we could know that there's going to be a conflict over there. You could just take that trade and move on. But I want to finish the trade. We said that we were going to do this and maybe buy an out of the money call with our credit from our short put. So you can't get more bullish than this in my mind. You sell a short put spread to buy an out of the money call. That is one of the most bullish trades that you can do in the option trading world. Because buying an out of the money call is very bullish just in general. All right. Anybody have any questions on it? If you have any questions, please do put them in the chat box. If you have any questions on Chewy, does anybody have the Chewy trade still on? Kind of curious where it ended up at. Like I said, I don't remember exactly what happened on the show because I put it on my account and I did it the next day. I adjusted that trade. Let's go look at Broadcom. Let me see if I find my screenshot. I think it was 46.43. Yeah, that's what it was. This Friday. I'm more curious where it ended up at. Because we did 3 points wide, Friday expiration, 46 is, I think, the one that we bought. Sold 2 of the 43s on our butterfly, and then we went down to the 41.5. So I remember that now, because I remember that half point strike, wondering why they had half point strikes. 172, 191. I like that number better. All right, so well, let me send this to the what if calculator, and then we'll just call this a day. We'll have a short and sweet Options Guy TV today. So if I look at this trade, here's what we did. The market was at 46. No, it was just above 46. We bought the 46 strikes, sold 2 of the 43s, and bought 1 of the 41.5s. By doing that, that means that this long put spread is 3 points wide, and our short credit spread our short put credit spread was 1.5 points wide. That means that at expiration, this thing has to trade for at least $1.50 if the market goes below $41.50, because we have more benefit from the long spread than we have risk from the short spread. So with that said, 150 is what we would have been looking to sell it at. And after the earnings announcement, you would have received 150. Right now, we're at 192, and we're in this area of flux. So it's going to be kind of fun to watch. From here on out, all the time value of our 43 strike put, our middle put, that is our risk, our risk on the trade, not basically, it is our risk on the trade. Those puts, that time value has to go away. So you're going to have a lot of fluctuation. You could go up as high as $3, and you could go down to 150. As high as $3 down to 150. Now realize that this chart is using today's prices, right? So I'm just using it as a I don't know, the profit and loss isn't going to be as accurate because it's not that when we put the trade on, we only paid 75 cents. Okay, so there's going to be a lot of gamma, a lot of movement in this price between 43 and 41 and a half. It's 194. If you held it all the way till Friday, I'd get out of the trade. I got out on Thursday. They announced Wednesday morning. I got filled on Thursday is what happened with me. All right. That's it for this edition of Options Guide TV. If you ever have any questions and comments, please always know that you can use the chat box. We want to make this a very interactive show if we possibly can. Want to thank Tradier once again for sponsoring this event and everything that they do inside hub.tradier.com. Please support them. Go in and make a sign on. You'll have access to it's 100% free, and you have access to all the great speakers that the lineup of speakers that Tradier has put together. And we'll see you this Monday for the next edition of Options Guide TV. We'll start anew. I mean, I guess we added to our trade from Wednesday, so we still will have that USO position on, but we'll look at a new trade Monday morning. And thanks for stopping in, and I hope you have a great weekend. And we'll see you Monday at 11 a.m. Eastern Time for the next edition of Options Guide TV. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.